Okay, so how does the HECM purchase work? So let's kind of go through just the basic process here. So you've got a client that you think kind of matches the criteria. They're close to or in their 60s, or above, and they come to you and say, hey, we're interested in selling our house, moving into something different. And, they've got a good cash down payment as far as what they would like to do. You then take that client and you say, well, I remember I took this class, reverse mortgage might be something that you may want to think about doing. And they say, great. So the first step that you're going to want to do is you need to make sure that you're connecting with a reverse mortgage professional that knows how to do these. I cannot emphasize that enough. It is very, very important that you use someone that knows what they're doing. They're going to meet with them. They're going to create what is called a proposal. The proposal is going to go through all of the ins and outs of the reverse. It's also going to have a projected purchase price, as far as what they're looking at. And from that proposal, and they're going to go to counseling. The counselor is going to be going over pieces of the proposal with them. And once they pass that, you then have the green light to go ahead and show them property. Okay, now I'm going to go through some numbers. I'm going to show you how easy this is for a lender that does reverse to be able to show you how much money they have to bring in, what their purchase price would be, all of that. But you find them a property, you get it under contract. All right, at that point, we do an application and we put in the property address, and then we are off to the races. All right, now this is an FHA loan, so FHA required addenda are going to be a part of this. Now, it's going to be very important as well that the listing agent on the other side of the transaction, that they have a conversation with the reverse mortgage professional that's handling this for you, right? Here's the reason. They're going to get an offer with an FHA addendum, and it's going to show that the buyer is putting down $250,000, $300,000, $400,000 as far as a down payment. And they're going to go, huh? That's really weird. So make sure that you have like I said, the lender calling to explain it so that they can go through it. This is one of the safest loans as far as an offer is concerned that they could get. And we're going to go through all of that as well. Once the offer is in and accepted, we obviously will move forward with getting the appraisal ordered and then move forward to closing. Now, HUD and FHA are going to randomly select about 6% of these for a second appraisal. Okay, this is kind of like customs. You walk through, you either get the red light or the green light. Okay, green light, you're good to go. Red light, we're going to have to check your bag. So if you get a red light through FHA's system after the first appraisal has been completed, a second appraisal is going to have to be done. Now that's going to put a little bit of a wrench as far as the time frame. And generally, depending again on who you use, I can only look to my own past experience with companies that I've worked for. Closing on a reverse purchase from start to finish generally is going to be anywhere between 17 days all the way up to 60 days. Okay, that's a big, big difference. A lot of it's going to depend on who you use and the ability of that group to get that loan pushed through. Okay, so kind of keep that in mind. Please make sure you're talking to the professional that's doing this. They can tell you where they're at. I know for what we do, we generally see 17 to 30 days is our average, but please make sure that you ask. Okay, this is how we calculate how much money that they need to bring in. All right, it's going to be based on a couple of different things. So we look at the max claim amount. All right, the max claim amount is going to be the lowest of three numbers. Okay, first one is going to be $1,085,000. I know that this says the max claim amount down here 970. That slide needs to be updated. This barely just changed, so that's been increased. The purchase price or the appraised value. So the lowest of those three numbers is the number, the value that we're going to take into our calculations on how much money the borrower has to bring in. That's one piece. Another piece is going to be their age. Again, the younger they are, the more money they have to bring in. The older they are, they don't have to bring in as much. And then where interest rates are. Interest rates, if they're lower, mean that, you know, we have a longer breadth or period of time that loan amount can stay low. If they're higher, then that affects the amount that we have as well. All right. So what I want you to remember is it's the lowest of the max claim amount of $1,085,000, the appraised value, or the purchase price. That's the important piece. Now, when you do these, FHA and HUD do not allow any seller credits or builder incentives. All right. So super important when you're structuring your offer and you've got a client that is purchasing a home with a HECM loan, you're going to want to make sure that you don't ask for any closing costs. And if you're with a builder, any incentives, you want those to be reflective on the purchase price of the house. Okay. Same thing goes if you're, you know, working with on a resale and your buyer wants to buy a property and it's been common in the market that, you know, hey, sellers are paying up to $8,000 in closing costs. In lieu of that, reduce down the purchase price by $8,000. That will have a impact on the amount of money that your buyer will have to bring in, because we're not allowed to let the seller pay for those closing costs. All right, so let's talk about cost. So one of the things that I hear is that these are expensive, and I agree, they are. Okay, now we're going to talk about, does it make sense with the expensiveness of it to do it? And I'll let you make the decision as far as when we go through the math on this. But the biggest expense is there's a 2% fee off of the max claim amount, which is again the lowest of $1,085,000, the purchase price or the appraised value. That's going to be an upfront MIP cost. We're going to talk about why mortgage insurance is important here in a few minutes. It is actually the only time when mortgage insurance is actually a good thing. All right. The origination fee, plan on between $4,000 to $6,000 is kind of what that is. And then traditional third-party closing costs. It's going to be title companies, things like that. Please remember the 30 to 70% rule of thumb. Again, if someone is younger, around 62, they'd have to plan on bringing in about 70% of the down payment. I'm sorry, not down, 70% of the purchase price. If they're closer to, say, late 80s, early 90s, it's going to be closer to 30% as far as the amount that they have to bring in. Okay, so here's an example. So we've got a 65-year-old client that would like to purchase an $800,000 home. I'm using an expected interest rate of 5.465%. Their principal limit, which is again based upon their age, the rate, and the value of the house at 800, is $322,400. Okay, we subtract out of that the closing cost of $28,000. That means the remaining principal limit, this is the loan balance, is $293,826. That means for this particular client, they would have to bring in $506,000 in order to purchase an $800,000 home. Okay, approximately 63%. Now I'm going to move to the next slide. The only thing that's changing on this next slide is that our borrower is older. So now we have an 82-year-old client that wants to purchase an $800,000 home. Expected rate 5.465%. Their loan amount, principal limit, is higher because again they're older, and their cash out of pocket that is required is only $402,000, so right around 50%. So again, the difference between being older is you have to bring in less money on the purchase. And we're going to go through some today's scenarios where we can actually rapid fire these through, show you how easy this is to be able to figure this piece out. Again, the cool thing about this with the reverse, required monthly mortgage payments are optional as far as principal and interest. All right, so why the mortgage insurance premium fund? Why is that important? Well, number one, it's an FHA loan, all right? But the mortgage insurance premium fund allows on this loan a couple of really unique features. The first is it is going to insure this loan and make sure that it is a non-recourse loan. So the heirs of the estate, as I talked about before, are not left holding any of the shortfall between what the loan amount is to the value of the house if it ever goes underwater. Second thing that it does is it protects the line of credit. I'm going to show you in some examples here at the end why this is so important. But those are the two main factors. Is it's going to insure the lender, it insures the borrower, and it insures the estate. Okay, any other insurance policy, I mean, as far as mortgage insurance out there, that is not a HECM loan, only insures the lender, which is why we want to get rid of it as fast as possible because there's no benefit to us. With the reverse, there is a direct benefit for the borrower and the estate. Okay, so we'll see how well you were listening. The principal limit calculations that determine the amount of the loan proceeds available to the borrower, this is the amount of the loan, include all of the following except product type, age of the youngest borrower or eligible non-borrowing spouse, the highest of the following, appraised value, max claim amount, and sales price, or D, the expected rate. Good job, everyone. I'm just kidding. You're all getting it wrong. Product type is one of them, but remember it is C, it is the lowest of the following, the appraised value, max claim amount, and sales price. So here's an example. Let's say that someone is using this and they want to buy a $1.2 million house. Well, the max claim amount is $1,085,000, right? So we would go with that as far as the max, the total principal limit is going to be based off of that value. Okay, even if the appraised value, let's say the appraised value comes in at 900, all right, we're off by quite a bit. So we then go off of 900 grand as the number that we create all of our numbers with. And again, I'm going to show this to you, so don't get discouraged. The math on this is actually starts to get really simple when you see it. Okay, which of the following properties is ineligible for a HECM? Single family home, HUD FHA approved condo, 2 to 4 unit property, or none of the above? And the answer is, oops. Don't know why they didn't go. The answer is D. All of those are eligible. Okay, challenge question number 4. What is your favorite food? All right. Okay, so our safeguards. Reverse mortgage. These are FHA loans. Guarantees no repayment of the loan until the last borrower moves out, sells, or passes away. When the client moves out of their home, the client or their estate has up to 12 months to repay the loan. No penalty for early payment. This loan is a non-recourse loan. So again, if the balance on the loan exceeds the home value, HUD and FHA make up the difference. The heirs of the estate keep any excess proceeds from the sale of the house. We do mandatory FHA counseling for all the borrowers and non-borrowing spouses and POAs. We do a financial assessment to determine if the borrower has the financial capacity to pay taxes and insurance. Non-borrowing spouse rule makes it possible for a qualified non-borrowing spouse to remain in the home even if the borrower dies. They just have to continue to pay property taxes, insurance, maintain the property, and keep it as a primary residence. The heirs can never owe more than the value of the house is worth when the loan is repaid. but most of the time there's going to be money left available for them. And again, there's no prepayment penalty. They can pay the loan down at any time or defer payment. Okay. So again, the most important things on the financial assessment is willingness and capacity for all of our seniors to make sure that everything is good to go there. All right, so let's run through some scenarios. Scenario number one, Dan and Mary don't have enough equity in their current home to sell it and buy the home they want or need with 100% cash. Dan has been diagnosed with a heart condition and can no longer walk up and down stairs. So they need a single level home similar to their current home. And after getting a pre-approval for a HECM for purchase, they sold their home for $650,000. Okay. So we got $650,000 as far as the home. Let's say they had a current mortgage on it. They paid off the mortgage of $150,000, $40,000 in commissions and closing costs. So they got $460,000 available to them to purchase the home that they need. So there's their $650,000 two-story home, which doesn't fit their needs anymore. So now they've got two options. Do we want to upsize or downsize? So let's go through the math on the upsize. So if they decide that they want to upsize, again, in both of these scenarios, they've got $460,000 in cash remaining to them after the sale of their home. So the cost of their new home on this example will be $725,000. The HECM proceeds for them, this is the loan, to be $298,700, which means the cash that they would need to bring in would be $452,000 and change. That leaves them with $7,038 of the $460,000 left in their account. So again, they sold, they upsized, and again, monthly mortgage payments become optional. They can downsize. So they buy a home that is $550,000 and their HECM proceeds are $226,000. They'd only need $345,000 in change to be able to purchase the house. And that means that they would have $114,000 remaining to them after buying this home, which they could, again, put into retirement account, stocks, bonds, checking account. There's a lot of places that could go that, again, they could continue to live off of. All right. But the cool thing in this example, and I want you to think about this, when you've got a client that, may be in a position to where they have to sell. And let's say that, they come to you as the agent and they say, you know what, we can't live in this home anymore. It's got stairs. We're now transitioning into needing a walker or a wheelchair. We need something main floor living. And you say, great. And you say, I've done a CMA on your home and we can get about $500,000 out of the sale. And you ask them, where would you like to go? And they say, well, we've heard about this community up the street and we're excited about it, but we don't know how much it costs. And we don't know if there's any availability. So they send you up to do some research and you come back and you say, all right, so I've got some good news and bad news. The good news is that they have some availability. The bad news is that the starting point is $700,000. So before taking this class, you would ask them and say, well, we're going to get $500,000 off of the sale of your home. Would you have the capability to get qualified for the $200,000 mortgage you're going to need and be able to stroke the payment? Or do you have cash in 401ks, IRAs, something that you could pull to be able to buy this completely? And let's say that they look at you and say, oh, shoot, you know what? We don't have any retirement accounts. So what we have, we want to keep. And we really don't have the ability with our income to stroke a mortgage payment. Now, up until today, you would say what? Well, let's find you something that fits within that $500,000 price point, right? But with this program, you could then take them to see and buy a $700,000 home using the money that they had off of the sale of their previous house, not have a monthly mortgage payment, and probably still have a good chunk of change left over that they would be able to use for life on it, whatever they'd like to do. So pretty cool. So now Dan, Dan and Mary have no monthly mortgage payments. They're only paying taxes, insurance, and HOA, and they have a significant amount of cash left over for future expenses. The HECM for purchase provides opportunities and options for today's older home buyers, which is exciting. All right, scenario number 2. Chuck and Linda want to build the home of their dreams. Chuck and Linda have a home that's too small and they worry about the future. They've wanted a larger home with a pool for the kids and grandkids to enjoy. And after getting a pre-approval with a HECM for purchase, they sold their home for $600,000. In this scenario, they had no mortgage and they paid off, after paying closing costs, they walk away with $576,000. So for them, they want to buy a $900,000 home. HECM proceeds for them would be $439,200. So that's what's available in the loan. They need to bring in $491,924. That means after buying a $900,000 home and using the $576,000 they had off of the sale of their previous house, they have $84,000 remaining, which is so cool. Okay, scenario number 3. Paul and Kim are getting a divorce. Now, I did try to find the 2 most unhappy seniors on the internet that I could throw up as far as a picture. So they're both 68, and only Paul has worked over the last 20 years. They turn to you as the agent for the listing. What are some options you can make available to them? Now, I'm going to open this up for just a minute. And I would like for you to kind of throw out, knowing what you know now about this class, what are some things that you could offer both Paul and Kim? Let's say, by the way, that they have their home paid for free and clear. Or better, if you're kind of stumped right now, let me ask you this. Without having this class, this is your client, Paul and Kim, and they come to you as the agent. How would you help them? What would be the direction that you would be pointing them to?
Well, I think originally we would say, can one of you buy the other one out or sell the house and split the proceeds?
Okay, perfect.
But now, with this, you could say, well, potentially one of them could stay in the house, do this program, and the other one, and use the cash to buy the other person out if they don't have the cash other ways, and the other person can go do this with their own property.
Yes, exactly. So there's 2 different scenarios here, right? So first, what would be the issue for Kim in a traditional sense on getting a normal mortgage? Kim,
no income history, no job history.
Yep, perfect. Thank you, Carrie. No job history, very limited income. She's going to be kind of left high and dry. Paul, even if he needs to cash her out, so to speak, in a traditional sense, he may not be able to afford half of the equity in the house as far as a new mortgage payment, right? So that's going to provide a financial strain for him. So when we look at doing this with a reverse, there's 2 different solutions. Solution number 1, the marital home remains with the first spouse. They go ahead and do a reverse on that home and they pull out money, they pull out proceeds that they then give to the departing spouse. The departing spouse then uses those proceeds in a HECM for purchase and buys a new home. Both spouses, the departing and the remaining spouse, do not have to make monthly mortgage payments. Okay, so they're back into the same scenario that they're currently in. Solution number 2, neither of them want the house. You sell it. They split the proceeds, both of them take half, and they go buy homes of similar value to the home that they just sold using the HECM for Purchase program. Now, with depending on what Kim is getting, as far as any type of alimony or anything like that, would dictate on if she would need to have a LISA, or that life expectancy set aside, set up for her or not. But this is pretty cool. This offers some options for them. And I work through a lot of these where they're trying to figure this out. And so it's a great option for them to be able to say, okay, this can still work. It's not going to financially cripple you. All right, scenario number 4, planning ahead for a line of credit growth. The HECM and the HECM for Purchase have a very unique quality that many financial planners are now recommending. A HECM can include a line of credit, which will grow at a rate 0.5% greater than that of the current adjustable rate on the loan balance. This grows independent of market conditions. So before I go to our next little piece here, I'm going to show you a real world example, all right? So for those of us that are making housing payments, I've got a couple questions for you. The first is, do you have to make your payment every single month? Yes, right? Well, we can choose not to, but very rapidly we would lose our house, all right? Second question, once you make your payment, can you take it back? We could try. We call a loan service and say, hey, you know what? I made my $2,000 payment last month, but I need that money. I'm planning on a trip to Paris and I need to pull that money back. Am I okay to do that? Okay. Of course, they would laugh at you and say, yes, all right, that's not how this works. Good luck with your trip to Paris and find the money somewhere else. Would it be awesome if I offered each one of you an option today? Those of you that currently have mortgages, here is your deal. You're going to sign paperwork with me today, and you can make payments on this. In fact, you're planning on it. However, if something were to happen and you came upon hard times, I would allow you to not have to make a monthly mortgage payment. And you're not going to get a nasty letter from me. You're not going to have anything hurt on your credit. Your loan balance will go up because of the interest carried there, but you can still stay in the home. And whenever you're ready to start making a payment again, go for it. No repercussions against you at all. Okay, that's the first piece. Second piece, every payment that you make, if you ever needed to take any of it back, we'll allow it. No charge. You don't have to do a refinance. You could take back any payment that you make on this loan. How many of you would sign up for that insurance policy on your current mortgage today, just in case? I would. Absolutely. Why not? There's no downside to it at all. But what if I added this little piece to it? What if I said, not only can you take the money back as far as payments that you make, but every payment that you make is going into a line of credit that is growing at 0.5% greater than the interest rate on your loan balance. And let's say right now your loan balance is, I'm going to throw out where we're at today. Let's just say it's 7.5. Okay. That's the interest rate on your loan balance. And every payment that you make will lower down the loan balance and dollar for dollar go into a line of credit where it's growing at 8%. And you can take that money back if and when you ever need it. Would that be something that would get us all excited? Okay, definitely for me, right? So I'm going to show this to you on how this all works, but this is what makes the reverse mortgage a financial planning tool and not something that is just a program for those that, you know, have run out of money, although it works for them too. So this line of credit is liquid. And again, optional mortgage payments decrease the loan balance and increase the line of credit dollar for dollar. Here's our little example. So home value, $800,000. The current HECM loan balance is sitting at $350,000. Their line of credit's at $50,000. Let's just say we've got the interest rates on the loan balance in this example at 4.7%. That means the growth rate on the line of credit is 5.2%. Let's say we make a $1,000 voluntary payment. You'll notice that the loan balance dropped down to $349,000. The line of credit increased by $1,000 to $51,000. Okay, pretty cool. All right, would there be an advantage to making payments on a reverse? Yes or no? Of course, the answer is yes. Why? Because again, every payment that we make, which is optional, is going to go into an account where it's growing, and we can take that money back anytime we want, which is really cool. Okay, we're going to go through a quick summary here, and then we're going to run through some real world experiences so that you can see how this is actually happening in real time. Okay, so Realtor Advantage. HECM for Purchase is a great alternative for people age 62 and older, as opposed to traditional mortgages. The HECM Purchase will separate you from your competition, no doubt. The informed realtor increases their earnings with this life-changing program while increasing the quality of life for their older clients. Your information of the HECM for Purchase has the ability to give older clients strategies to relocate and be nearer to family and friends, downsize, upsize, maintain an active lifestyle, increase purchasing power, boost retirement funds, and create financial longevity. So some things to kind of think about. Look back over your book of business. Eligible age borrowers that you could not help, maybe in the past. Maybe they weren't able to qualify or move into something that better fit their needs. Parents of clients who are contributing to a parent's home expenses. Retirees looking to relocate. Highly recommend, if any of you are kind of getting a little jazzed about the opportunity here, please sign up and become an approved SRES Realtor. This is a designation that is offered through the board, and it really helps you become more involved with the retirement ecosystem. And then partner with a specialized HECM for Purchase loan officer. Yellow is able to run numbers to create scenarios, give you parameters for looking for available properties for your borrower and your buyer, and provide marketing materials that you can use as a joint marketing effort. Okay. All right, so what we're going to do next is we're going to run through a couple of scenarios here. Okay, so scenario, the first one that we're going to be doing here has to do with line of credit and how a line of credit actually builds and works through the system. So in this example here, we've got a 62-year-old borrower, $500,000 property value. I'm saying that that property value is growing at 4% appreciation rate, which is our average here in Utah since the 1950s. They have initial principal limit of $167,000. We're going to finance their closing costs, and right now, the interest rate that we're looking at is 7.54%. So again, this is someone that has their home paid off. Oops. This is someone that has their home paid off, and they're looking at doing a reverse. All right, so let's see what this is and how this works. Okay, first off, their loan balance starts at $19,347. This is the closing costs that would be associated with this loan. They would have a line of credit of $147,653, of which in the first year, $80,000 would be available to them. Now, this is an important piece that I want to go over. There are two different types of reverses. There's a fixed rate reverse, and there's an adjustable. If this client decided to do a fixed rate reverse, this is the amount of money that they would have to draw immediately. And this would be added to this amount, and that would be their loan balance. Okay, that's all they have, and they have to take it in one go. Because it is a closed-ended loan, they would not be able to have the advantages of line of credit and line of credit growth, or be able to take out different payment terms. So that's why 99% of these reverses are adjustable, because they have this factor into it. Okay, so after the first year, you'll notice that the full line of credit is now available to the borrower in this liquidity bucket. Okay, so this is available funds for them to draw. Now, what I'm going to do, by the way, house value I have increasing at 4%. The equity position is the house value minus the amount borrowed gives you equity. We're going to move this forward a few years here, and we're just going to watch that line of credit grow. Okay. Now at age 74, that line of credit has now grown to $340,000. This is available money that I can draw. And if I draw it, again, it's going to go into a couple different places. First, if I draw it 10 grand, it would go into my amount borrowed. Because it becomes a part of the loan, that $10,000 that just came out is not taxable. And is not seen as income. So that money goes right into my checking account, and I'm able to use that for life. Conversely, if we make any payments here, if I made a $10,000 payment here on this 44 grand, that's going to increase my line of credit by 10 grand. My amount borrowed decreases by 10 grand. As we move this to say age 80, 82, we're getting close to almost $600,000 in that line of credit. Again, that's just organically growing. And by the time we're in our late 80s, we've got $1 million sitting there. Okay, that's available. Now, what would happen at this moment in time? Let's talk about a couple of things. First off, house value projected 4% increase per year by the time this client's 90, which is almost 30 years from now. Let's say that they pass away. And let's say that they haven't touched this line of credit at all. It's been there, it's been a safety blanket, they haven't had to need it. The heirs of the estate, again, would have 30 days to make a decision. Do we want to keep the house or not? If they want to keep the house, just refinance that $135,000 loan balance, and they're able to retain it. If they want to sell the house, they would list it for 1.5 million, pay off the loan balance. That's the equity, that 1.36 million that would be given to the estate. All right. Now I talked about the provision that the line of credit can never be frozen. Okay, this is beautiful and it's protected. That's why we have a mortgage insurance. What happens if at age 90, I got a diagnosis that I had 6 months left? And let's say that that corresponded with a massive crash in the market. Let's say that the house is not worth 1.5 million. Let's say that it's only worth 500,000. Okay, we're talking about a monumental crash. Everyone is going to be crying except for me and for my estate. The reason is this line of credit is still completely available to me. All right. I could draw out all $1 million and park it into my checking account. Now that would make my loan balance 1.1 million, almost 1.2 million. I pass away. Let's see if we're following here. So I pass away. I've got $1.2 million on this loan balance, and the house value is only 500 grand. You, as the heirs of the estate, have a decision. Do you want to keep the house or not? Now, the cool thing is I just parked $1 million in my checking account. That money can be used however you want. You could decide to let the house go, and the difference between the loan balance and the house value would be taken care of with the mortgage insurance. Or you could say, gosh, I remember we could buy this house at 95% of the current appraised value. You buy it at 475, you use part of the $1 million that was sitting in that line of credit, which is now in the estate, to pay for the purchase. And now you own a home in a down market at a discount, and you've got money left over. Okay, power of the line of credit. Now, we might say, all right, Matt, it's just expensive, like 19 grand, that's kind of high, right? As far as closing costs. This is what I would do with my own personal HECM. I would say, all right, I understand that this is closing costs, this started the loan amount. But I also understand that if I make a payment on this, that money's going to go right into my line of credit where it's liquid and growing. So I'm not going to pay off my loan balance, but I'm going to pay it down. And I'm going to make a one-time payment of 18,000. When I do that, watch my line of credit grow. That money is still 100% available to me. And it's in this line and it's now growing. My loan balance, I want to keep just a hair over 1,000 because that's safe. That money is never, that the loan is not going to get closed out on me, right? Now I'm going to let this grow over time. Again, this is my safety blanket. I may never have to touch this money. I will, because I'm going to strategically use it with my other accounts. But by the time I am 80, I now have 579,000. Now, by the time I'm 90, obviously we're well over $1 million, which is great. But this is how we strategically plan this. I say, all right, I'm still working in this scenario at 62, and I'm going to work until I'm 72. I'm going to move this forward 10 years. At 72, my line of credit is now growing organically at about let's see, 32 to 56. We went up by 24,000. So I'm going to say, all right, so at 73, I'm going to start to take out $2,000 a month as a draw, as additional income. I'm basically going to be taking the cream off the top, and I'm going to start that in my 10th year for the rest of my life. So let's follow this. So originally, I'm going to invest some money in here so that my line of credit grows more robustly. I'm going to move this forward 10 years. I'm still working. And then at this point, I'm going to start to take $24,000 a year on a draw against my line of credit. You'll notice my amount borrowed just went up by 24 grand. My line of credit only just barely decreased. That's because I'm just taking the cream off the top. And again, I'm taking $24,000 a year now for the rest of my life. And at any point during here, if I needed to take more money, I have access to it, which is pretty cool. Well, let's say that I've been doing this for a while, and at age 90, we get to this point, I'm like, okay, I want to take everyone, all of my children on a great cruise or something like that, build memories. I take out some extra money. And, now we're looking, our amount borrowed kind of goes up. This is where the value of the house is. Let's say at that moment I pass away and decide that you want to sell the house. So list the property, pay off the mortgage balance, remaining equity gets split with the estate. But during this period of time, I've been able to use money to help me to continue to retire well and to have cash flow. All right, we're going to pull up another scenario here. Any questions by anybody, by the way, on this piece before I move to another aspect of it? Okay, we're going to move on to our next one here.
I think we've all just been wondering if we get the slides.
Oh, yes, great question. All I need is an email address from you. If you can give me an email address, I will share with you my slide deck.
Where do we send the email address?
Remember in the chat, I put the Google form in there a few times. You guys will need to fill that out for your CE credit with all of the answers to the questions, the 5 key questions. So don't forget that when the class is over.
So email in there is all we need to do?
Well, fill the whole form out.
Right, but
Yeah.
that's fine. Okay.
Yeah, and I'll get that to you. This particular software program, I'm going to show you how easy this is because I'm going to rapid fire this. But this is something, again, if you want to go in more depth, just connect with me. More than happy to share it with you. Okay, so in this example, I'm gonna have someone that has an $800,000 home. And I'm gonna say that they have a $150,000 mortgage that's still remaining on that home. And we're going to see how the reverse plays out in this scenario. And then we're going to work with the purchase. And then we'll be done. All right. So we're going to go in here. Okay, so this particular client has an $800,000 property value. From the group, do you want me to put in? Actually, I'm going to leave this blank for now. We'll do that in a minute. Current mortgage balance, 150,000. Let's say they've got a killer interest rate, 2.5%. And they are paying $1,500 a month in a payment. All right. This is their current mortgage balance, okay? $150,000. They're doing a forward normal mortgage. They're making payments of $1,500 a month. House value is 800 grand, $650,000, and they're looking at their months remaining. They're like, yes, we have about little less than 10 years, and we're going to be wrapped up with this baby, right? We won't have any more monthly payments, but right now they're spending $1,500 a month, $18,000 a year. And by the time they have this paid off, they would have spent $168,000, right, with interest. If we do a reverse, we're going to throw closing costs in here. And immediately they're going to have a $90,000 line of credit, of which $26,720 is available to them in the first year. After the first year, the entire amount's available. But at this point, they no longer have to make mortgage payments. Okay. I'm going to move this forward 1 year. We're going to talk about it, and I'm going to do a side by side. So house value projected to increase by 4%. Our loan balance increased because we're not making any payments. Our line of credit increased, and we were able to save $18,000 in payments we did not have to make. Okay. So again, over here, this is the current mortgage. This is the HECM. And again, the only thing different we're doing here, we just switched it over, and I no longer have to make payments. And I'm going to move this until we have this loan paid off. Okay, at this moment in time, 9.5 years later, we now have our forward mortgage paid off. Yay, we don't have any more mortgage payments. This is our house value, got great equity. Over here, we did a reverse. We still have a mortgage balance. However, we have $182,000 in our line of credit, and we have $168,000 in our checking account in payments we didn't have to make. Okay, equity position, still looking at 830, but we've got a total liquidity position of 182 plus 168. That's $350,000 in additional liquidity. All right, which is pretty cool. We have $350,000 in additional liquidity, or we have zero liquidity, but we have a paid off house. Now, I'm going to argue that putting $1,500 a month in your checking account, if you're still working, because you're planning on making that payment anyway, is not the best use of your time. So what happens if we put that money into a growth account, you know, stocks, bonds, IRA, something that's going to be growing over here, instead of putting it in our checking account? So again, a side by side, the only difference we're going to do in this example is instead of making our mandatory mortgage payment on our current mortgage, we're going to make our payment here into a growth account. We're going to move it forward in the exact same amount of time until we have that paid off. This is our difference. So we've thrown in our money here. We have $220,000. That's growing at 5%, which is extremely conservative. Our line of credit has been growing. That plus our savings gives us a liquidity position of $402,000. Again, the only difference that we did is instead of making a payment here, which we have to make, we self-directed that payment to where it could actually be doing something for us. And now we've got a liquidity position of $400,000 that we have available to us that we can use for our retirement. What happens if we decide to just make our payment? Okay, again, the only difference here between these two is instead of making my payment here, I'm going to get a reverse and make a payment. Okay, and I'm just going to be, I don't have to, I don't get something in the mail that says, yes, you have to make this $1,500 a month payment, but I'm going to do it anyway. And we're going to move this forward until we have this paid off. My line of credit has grown to $429,000. My amount borrowed, $106,000. From here moving forward, I could then strategically start to draw on this line of credit if I wanted to, or I can just sit there and let it grow. See how cool this is? Now I'm going to add in just a little bit of a wrinkle, and then we're going to run with a purchase. Any questions on this, by the way? Isn't this awesome? Hopefully we're getting nods. I can't see everybody, but to have the liquidity position available to you is huge. The line of credit can never be frozen, and it's always available to you. Over here, you got great equity, but it's like I said, it's tapped in and you're not able to really do anything with it unless you get a HELOC, sell the house, or get a cash out refinance. All right. What we're going to do here is I'm going to add in that these guys have a very healthy $500,000 in their growth account. Now, I want you to watch this borrowed amount, okay? Actually, I'm going to do this. I'm going to put this in another spot here. All right, so we've got money that's sitting in IRAs, 401ks, something like that. And I'm going to do a self-directed payment in here for the next, few years. I'm going to let it grow. And I'm going to show you one of the magic pieces to this. This is where my high net worth individuals get kind of excited about it. As I move this forward through time, we're putting that contribution here and it's growing. And we're going to take this to where we have this paid off. At that point, we're not making any more contributions. Right now at age 74, I have to start taking money out of these qualified accounts. My amount borrowed has grown though. Okay, so I want you to see this. We grew from 176,000 to 406. Let's just call it $230,000, give or take. I could take $230,000 out of my IRA account. Okay, now let's say that that's a taxable account. I'm going to get a 1099 for that withdrawal, right? That I have to pay taxes on. But if I take that $230,000 and I make a one-time payment on my reverse, it's going to do three things. The first thing it's going to do is it's going to lower down the loan balance by 230 grand. Second thing it's going to do is it's going to go right into my line of credit for $230,000 in addition, right? And that money's liquid. I can pull it right back out, and I just paid $230,000 of interest. I don't know what tax laws are going to be in the future, but if I can take a 1098 for $230,000 and use it to offset anything on the 1099 for that $230,000 withdrawal, that is a beautiful thing. Okay, We're gonna park here for just a minute. By the way, your last question for your challenge question is, did you learn something new about reverse today? All right. I'm going to show you something really cool. I want one of you to give me the scenario. I'll show you how fast this is. Give me the age of the youngest borrower. Right now I've got 62. Just throw out a number as far as an age. Come on, guys. What do we got?
67.
67. All right. So take off 5 years there. Okay. And your client's going to buy a property. What's the purchase price of the property they want to buy?
700.
$700,000 purchase. Okay, they would need to bring in $467,352 to fund their purchase. And at that point, principal and interest payments would be completely optional to them. Okay, anyone have another one you want me to throw out? So by the way, that 467, that increases obviously the equity position. Their loan amount would start at about 259. Okay, anyone else? All right. So I hope all of you can see that this program has some really fun pieces to it. I appreciate all of you. Let me go ahead and stop share here. I appreciate all of you for the time that you've spent to be here today. And again, if any of you give me your email address, I will send you the slide deck. I'm more than happy to do that. And really, if any of you have any other questions, from the email, just get in contact with me. More than happy to run scenarios with you. If there's any piece to this, you're like, hey, Matt, I just need to understand this a little bit better. Please, my goal is to educate you and to help you to really know this program really, really well. My contact info. I will type it in the chat here for you. Okay, any other questions before I let you all run away?
You did a great job. Thank you. Remember everybody to download that Google form. That's how Matt's going to get you your credit. And I will stay on for about 10 minutes so that you guys have the chance to fill that in. I'll give you the remainder of the day and then I have to give it to him so he can record it so you guys can get credit. Thank you.
Yeah, there you guys go. Appreciate you all. Thank you so much.
All right. See ya.
Tana, thank you.
Yes, of course. Thank you. It was wonderful.
Great.